Derivatives are financial instruments that derive their value from an underlying asset such as a stock. Examples of derivatives include options, futures, and swaps. These instruments are used heavily in finance because of their versatility, particularly in combination with each other and other tools. They can be used to hedge or reduce risk, to create synthetic stock positions, and to take advantage of arbitrage opportunities. A very powerful tool is the option. An option is a contract that gives the owner the right but not the obligation to buy or sell an asset at a predetermined price after a given interval. Although the American option allows holders to exercise the option at a time prior to the end of the contract, this analysis will assume that all options are European options in which the holder chooses to exercise only at the end of the term. As with other assets, options can be bought and sold. These commitments to buy or sell are referred to as positions. An investor has a long position in an option that he or she has bought, and a short position in an option that he or she is selling. Two types of options exist: the call option, which gives the owner the right but not the obligation to buy an asset at a predetermined price at the end of the term, and a put option, which gives the owner the right but not the obligation to sell an asset at a predetermined price after the interval. When an investor purchases a call option, considered a long position, he or she is purchasing the right but not the obligation to buy an asset at a given price. The net profit for a long call is in general the greater of either the spot price less the strike price and less the contract premium, or a loss of the contract premium. The long call is a hedging strategy as it acts as insurance for investors. If the stock price drops, there is a floor that the value of the asset cannot go below. This strategy is comparable to buying insurance for your home or automobile. In contrast, a short call position is held by an investor who sells or writes a call option for an asset. For this scenario, the investor is betting that the spot price of the asset will drop and remain below the strike price. If this is the case, the buyer of the call will let the contract expire, and the investor is left with the premium paid for the sale of the option. If the spot price of the asset increases, however, the buyer of the option will exercise it, and the investor will have to sell the asset at a loss. The short call by itself is a risky strategy. It is typically used in combination to set up a scenario where profit is made if the stock price varies either up or down. This strategy is used as a building block to achieve a short call butterfly or a short call calendar spread. The long and short positions can also be held for a put. For a long put option, the investor buys a put option or the right to sell an asset at a strike price after an interval of time. This strategy pays off when the spot price of the asset falls. The investor can then exercise the option to sell the asset for more than it's currently worth. The net gain in this case would be the strike price less the spot price and less the premium for buying the put option. Alternatively, if the asset price increases, then the investor would let the contract expire and would have only lost the premium paid for the contract. The long put acts as insurance from the rise of an asset value during a short sale. The investor will utilize this strategy when a drop in the market value of the asset is expected. The best case scenario for the investor is if the asset value drops to zero. Finally, the short put position allows the investor to sell or write a contract allowing the buyer to sell back an asset at a fixed strike price after an interval of time. The investor earns the premium of the contract and bets that the asset's spot price will increase. The net cash flow then is either the premium or the strike price minus the spot price, but with the addition of the contract premium. Similar to the short call, the short put by itself is a risky strategy. Maximum gain is the premium, while maximum loss is theoretically infinite. This strategy is usually used as a building block for a short put butterfly or short put calendar spread. Options can also be used to create a synthetic stock position. A synthetic stock mimics the payoff characteristics of a typical stock, but it does not require the ownership of actual shares. Instead, the synthetic stock position is composed of a combination of derivatives. These are advantageous because they require less capital to hold the same position as a regular stock. If an investor holds a long call position and a short put position with the same strike price and expiration, he or she has a synthetic long stock position. Supposing the stock rallies and the spot price exceeds the strike price, the short put would become worthless and would expire. Concurrently, the long call would allow the stock to be bought at a lower price than the market value. This difference is analogous to the gains made by a regular stock. Alternatively, if the spot price of the stock falls below the strike price, the long call option will be allowed to expire and the short put option will be exercised by the buyer, costing the investor the difference in the strike price and the spot price. The similarity between the synthetic stock and the regular stock positions is evident when viewed graphically. The figure on the left shows the profit and loss of a long call in green for a short put in orange and the resulting synthetic stock in red. To the right, the synthetic stock is compared to the regular stock. While the characteristics of the two are the same, it is important to note that the payouts may not be identical. Often the premium for a call is higher than that of a put, and this is a factor in the discrepancy. Other factors such as transaction costs can also affect this. However, these influences are not considered here for simplicity. The synthetic short stock position is very similar in principle to the synthetic long stock position, except it is composed instead of a short call and a long put. Both synthetic and regular short stock positions have unlimited risk and profit potential, profit occurring when the stock loses value and loss occurring when the stock rallies. The figure to the left shows the resultant payout in red for the combination of a long put, shown in orange, and a short call, shown in green. The figure to the right plots the synthetic stock and the regular stock behavior depending on the spot price at the end of the term. A numerical example further compares the synthetic and regular long stock positions. Assume Google Inc. is trading at $923 per share. If the strike prices for an August long call and an August short put are both $915 and the premiums are $30 and $20 respectively, then when the same number of each are combined, they form a synthetic stock position. In this example, we will assume one call option worth 100 shares will be bought and one put option also worth 100 shares will be sold. This is equivalent to 100 shares in the long position of a regular stock. The cash flow required to obtain the synthetic long stock is the put premium minus the call premium of 100 shares, for a loss of $1,000. We will assume the spot price of the stock rises to $950 per share at the end of the option's duration. With the stock trading at this price, the call is exercised and the put is allowed to expire. This means no cash flow occurs as a result of the put, but the call, on the other hand, generates a profit of $3,500. Although the spot price of the stock has risen, the option allows the stock to be bought at a lower predetermined price. The net profit of the synthetic stock is $2,500. To compare the synthetic stock results to the regular stock results, it is assumed that the same 100 shares are bought. Since Google was trading at $923 initially, it will cost $92,300 to buy 100 shares. If the spot price rises to $950 per share, the stock can be sold for profit. The net gain would be $2,700. Both the synthetic stock and the regular stock generated a revenue in this case, but clearly the payout is not the same. This is due to the variation in the option's premiums. Other factors such as transaction costs can affect this too, but for simplicity these were not included in this example. One additional note to make is that this cost can be offset by lending a specified amount at a risk-free rate. This is called the put-call parity. So if synthetic stock behaves the same as the regular stock, why would one go through the trouble of creating it? Why not just always buy regular stock? Furthermore, in the previous example, the synthetic stock was less profitable. The answer is leverage. The synthetic stock position allowed the investor to enter the market with less capital. In the previous example, only $1,000 was required to obtain the position, while $92,300 was required to buy the same amount of stock outright. Other advantages exist for synthetic short stocks because they do not require shares to be borrowed to short sell. This means no borrowing fees, and there's no need to reimburse the lender for any dividends that might be earned while the stocks are borrowed. Also, the synthetic short position can be utilized regardless of short sell rules. Index arbitrage is another financial instrument that relies on derivatives. It focuses on exploiting the price discrepancies of an index futures contract and the current value of the index. For the following explanation, let F be the price of the index futures contract, S be the spot price of the index, and T be the time to expiration of the futures contract. Recall that arbitrage requires no initial negative cash flow from the investor, so funds may need to be borrowed or lent at rates R sub B and R sub L respectively. An arbitrage opportunity may exist when the price of the futures contract is greater than the spot price of the index. To take advantage of this, the futures contracts would be sold and the equivalent stocks of the index would be bought with money borrowed at a risk-free interest rate. At the end of the interval, the futures contract is realized and the stocks that were previously bought at the beginning are now sold at the futures price to meet the contract agreement. The profit is the difference between the futures price and the spot price modified to include the interest from the loan. Clearly, the opportunity exists when the futures price is greater than the spot price combined with the loan interest. It can be seen that when the futures contract price varies from the spot price by more than the calculated amount in either direction, one can make a profit. But this model is lacking additional but realistic factors in the form of transaction costs and dividends. In fact, transaction costs are responsible for drastically reducing the presence of arbitrage opportunities. Some of these transaction costs must be paid to acquire the arbitrage positions. If the futures price is above the index of the stock, then the stocks are bought. If these pay dividends while they are held, this is additional profit. However, if the futures price is below the index of the stock, the strategy is to borrow and short sell the stocks. If these pay dividends in this scenario, the arbitrager would be responsible for reimbursing the owner. In both cases, transaction costs would need to be included. These requirements push the bounds of profitability further out, reducing. One might ask, if index arbitrage is essentially free money, why doesn't everyone take advantage of it? One answer is that the amount of borrowing power required for it to be profitable is immense. Many stocks need to be borrowed or bought to meet the index arbitrage conditions, and the average person does not have this ability. It is typically large money managers that use index arbitrage strategies. It is also important to note that when profitable opportunities do present themselves in the market, they do not stay open. If the futures contract for an index is mispriced, it is actually arbitragers that restore it to equilibrium. The demand to buy or sell the contract influences the price. For example, a futures contract priced low will be sought after by many, so due to the demand, the price will climb until it reaches the fair market price. If the average person did have the borrowing power to take advantage of an index arbitrage opportunity, it would still be difficult because this opportunity window is short. As a matter of fact, it can be mere seconds long. In today's technological age, many parts of the market are run electronically. Algorithmic trading involves use of coded programs that analyze the market and can seek out profitable transactions. Algorithms for index arbitrage exist and can determine discrepancies between the price of an index future and the underlying stocks. In fact, some of the computers running these programs are hardwired directly into trading hubs like Mahwah, New Jersey, where the computers for the New York Stock Exchange reside, so that they can buy or sell stocks and futures in transactions that take place within 1 second after a change in the market. Swaps are another powerful derivative that are used in hedging strategies. An interest rate swap occurs when two parties agree to terms of a contract allowing one party to translate fixed interest rates into floating interest rates. The party who pays the fixed interest rate is said to buy the swap. The other party must swap a fixed rate for a variable rate and is said to sell the swap. Rather than two parties write a check each month, one difference check is written from one party to the other as a difference in payment. This difference check will vary in amount, as well as who pays who, based on the delta between the fixed and variable interest rate. In general, the strategy of buying a swap is to have more predictable fixed costs over a long period of time. The strategy of selling a swap, conversely, is to take on additional risk with the chance of paying less over the long run. Foreign currency swaps began when currency values were no longer tied to a tangible asset such as gold and could vary relative to one another. In general, two parties initially trade an equal amount of two different currencies. The two parties then pay each other installments of the respective borrowed currency until the initial amount is paid back completely. In this numerical example, firm X, who typically operates in US dollars, borrows 1 million yen from firm Y. Firm X will then pay back 10,000 yen per month for 100 months. The amount that firm X will pay monthly will vary based on the exchange rate. Firm X will make a profit if the value of yen drops relative to the dollar. The figure shows history of exchange rates between the US dollar and Japanese yen. In conclusion, derivatives are powerful tools that can be used for many purposes. Options can be used to create synthetic stock positions that leverage the investor's capital. Futures can be used to take advantage of arbitrage opportunities. And finally, all three, options, futures, and swaps, can be used to hedge risk.
We are going to start as following in order. First, we are going to talk about the introduction, then general overview for futures and options will be provided. For further details, we divided options and futures in construction business and take a look at deeply on that. For futures in construction business, we took an example of steel market as a key indicator for construction business. Finally, we made a conclusion. According to the CFMA, Construction Financial Management Association, in 2007, a half of 400 contractors bankrupt in 2006 due to its financial mismanagement. Construction business is one of high-risk industries which are subject to experience unbalanced cash flow, and to face financial risk. Along with financial management, risk management is another key element for successful construction business. Since construction business is interconnected to many industries, it is easy to be exposed to and affected by any detrimental circumstances in other industries. Financial risk can be one of the environments that can impact on business atmosphere in construction works. A good example is Dubai construction bubble collapse, mainly caused by global financial crisis in 2008. Therefore, managing financial with proper risk management is mandatory to succeed in construction business. For those reasons, financial management and risk management are very important for construction business. And there are two major financial methods, which are options and futures. Both are based on the concept of risk hedging. Let us discuss about a general overview for option first. Option has a right, but not the obligation to purchase or sell an asset at fixed strike or exercise price. There are two types of options. First, call options, which is right to buy the asset, and second, put options, which is right to sell the asset. Let's take an overview for futures. Futures is an obligation to buy or sell a specific amount of an asset at a specified date and price. There are two strategies applicable to futures. First, going long. Going long is a kind of the contract to buy and receive the delivery of the underlying asset price. Second, going short is a contract to sell and deliver the underlying asset price. A comparison table is provided here to see the differences between options and futures. For options, buyer pays premium while there is no premium for futures, and there is no obligation to exercise for options, but for futures, it is obligated to exercise the contract. Option has a limited liability to premium, while unlimited liability for futures. Option is more volatility than futures. Real option is a concept to improve a limitation of typical financial theory, such as investment strategies, which are evaluated by NPV. It is utilized to evaluate the values of construction companies or projects, because it is applied in practical business environment and relationship between assets and properties of companies. Real option can be applied practically to a project that a company has the plan of technical development and investment. Furthermore, the company can get opportunity cost into their future strategy. It makes the company can consider broad strategies, as the construction business are getting more unpredictable and involving huge uncertainties. Real option theory gives different option values, depending on the level of uncertainty and irreversibility. The theory states that the decision makers can get more option values for their project when the irreversibility of project or investment is high. Now we can see the real option concept in this figure. Conventional view analyzed that the value of projects or investment decreases when the projects involve huge uncertainties that are difficult to predict or handle. However, real option concepts analyze that the value of project increases when the projects include high uncertainties, because the concepts put managerial options as a value of project or investment. This table shows when and how Thus, real options provide values. It says that higher uncertainty and higher irreversibility lead to higher option values. The companies are flexible in responding to the diverse business environments. With these variable assets, construction companies can take following features for highlighting their project strategies. 1. Conceptual modeling for intrinsic values of projects. 2. Applicable for long-term and short-term project forecasts. 3. Reducing assessment cost of project values once companies set up their model. However, there are a couple of factors that construction companies should know to apply real option approach method to convert these uncertainties of projects into opportunities. This method is hard to directly apply to practical construction business. One of the main reasons is that it is highly focused on evaluating value of future projects. The method is critically subjected by input variables because most of real option researches have limitation of particular project types as they apply different input variables. Therefore, the method is difficult to use at both types of projects generally. Following are features that construction companies should review before analyzing project value with real option method. 1. Lack of correlatable definition between economic opportunities and enterprise value. 2. Need particular criteria to apply regional projects. 3. Reluctant results depending on input variables. For the purpose of this paper, we made our focus on steel. Steel is the world's heaviest traded commodity by value after oil. It is a major raw material input for modern infrastructure development, and its demands have been increasing during the recent growth period of emerging markets as China, India, and Brazil. Such a high demand is driven by the development projects, mostly for infrastructure and real estate projects. However, steel industry around the world has been faced with a price volatility over different periods of time, which has been reflected as an added pressure on production and consumption of steel. Volatility in steel industry has been fueled by various factors like demand-supply imbalance, raw material prices, and changes in the crude oil price. Futures contracts are currently available on 6 different exchanges as following. 1. London Metal Exchange, usually called LME. 2. The Dubai Gold and Commodity Exchanges. 3. National Commodity and Derivatives Exchange in India. 4. Multi-Commodity Exchanges of India. 5. The Shanghai Futures Exchange. 6. Chicago Mercantile Exchange. The major problem with the steel future contract in the past was the very low volume of contracts. This fact highlighted that the steel as a commodity is not attractive to be traded on futures for hedging. Moreover, fluctuations in price is not a strong motivation for speculators. Most producers agree that fluctuations in price are based on overproduction or sudden increase in demand from representative economic reasons, which have a similar supply and demand to international markets. So the problem on steel futures in particular is the liquidity in terms of trading volumes on future exchange. With high liquidity, the companies tend to engage in substantially large open positions in future markets, and this future market tends to stabilize the underlying commodity prices to a certain extent, which is not the case with steel, since many companies are not affected by the trading of steel futures. In conclusion, construction business is subject to high financial risk and need financial methods to manage for successful business. Options and futures are useful tools for financial management of construction companies in terms of risk hedging strategies. Real options is helpful to predict future project variation. Real option is helpful to predict future project variation. Compared to previous future strategy analyzing methods, real options may predict and generate advanced results that company wants to foresee. However, it still needs to consider various input factors to get a concrete result in project evaluation. Steel futures is one of the emerging futures in the market because of its increased demand around the world, especially in developing countries. Now there are 6 future markets exist, and steel is traded as an underlying asset or futures. Its success as a risk hedging method in developing economy or construction industry will be relying on the liquidity of the commodity. In our further study, we want to do more researches on options and futures. In case of options, we will further study for applications of feasibility on construction business by considering more variable input factors in order to analyze the future project evaluation. For futures, we are going to research the case study about the real construction companies, which have steel futures contracts for financial risk management. This is the end of our presentation. Thank you very much. Compared to previous future strategy analyzing methods,
Hi, I'm Nathan Elo, speaking on behalf of my group with Julia Rend and Enzo Ogoa. Today I'll be talking about option strategies for managing. A quick overview, we'll go over an introduction to options, followed by basic strategies, then combine them in spreads, straddles, and then protective options. First of all, options give an investor the opportunity for profit potential while capping their risk at the premium they pay for the option. Sellers of the option have the opportunity to hedge their own risk if they think their asset is going to increase or decrease in a way they don't want it to, but they don't need to sell the asset to protect it. The buyer of a call option has the right but not the obligation to buy an agreed quantity of a financial instrument. In this case, we'll use stocks from the seller of the option at a certain time, the expiration date being that time, for a certain price or the strike price, where the writer is obligated to sell the financial instrument should the buyer decide to exercise that option. The buyer pays the premium for the right, but the seller gets to keep the premium regardless of whether or not the buyer exercises the option. So from the buyer's perspective, the buyer is hoping that the price of the stock will increase in the future while the seller is looking for the price to decrease. If the buyer is correct, they can exercise the option and enter the long position on the stock or sell the option and earn some profit. If the buyer is incorrect, though, they lose all of the premium they invested and the seller keeps that all. If the seller is incorrect, then they have to deliver the underlying stock to the buyer at the strike price, which can be significantly lower than the new value of the asset. So they can lose a considerable amount of money. Using some numbers as an example, say $4 per share. An investor thinks it's going to rise, so they buy a call at $5.50 per share for $550. They'll break even at $65.50 per share. And looking at the graph on the next slide, we can see what their profit does. As you can see, if the share price increases, the profit for the buyer can increase considerably. But that loss is always capped at the $550 premium. The next type is the long put. This is the other basic option where the buyer of a put option has a right but not an obligation to sell the stock at the strike price by the option's expiration date rather than buy it. The seller has an obligation, though, to repurchase that stock at the strike price if the buyer exercises the option. So in this case, the buyer is looking for the value to decline, where the seller wants the value to increase. If the buyer is correct, they can exercise the option or sell the option. And if they're incorrect, they lose the whole premium. The seller keeps the premium regardless. But if the seller is incorrect and the buyer exercises that option, the seller has to buy the underlying stock from the buyer at the strike price, which may be higher than the actual market value of the stock at expiration. So again, looking at some numbers, starting at $54 a share again, and say they pay $89 premium for a 100 share put. And the strike price at $50, the break even would then be $49.11. As the price goes down, the buyer is going to be in a better position. And looking at the graph on the next slide, you can see as that price is down, the gain is a lot higher for the buyer until there's the break even, and as the stock price then increases, rather than continue to lose money, the buyer has losses capped at the premium they paid. So when you combine more than one of these, you can get spreads, and with the first spread we'll talk about is the bull call option. And the buyer of the call both sells a call option at a higher price and purchases a call option at a lower price. Both the higher and the lower call options have the same expiration date, but the premium that they gain by selling the higher call option is used to offset the cost of purchasing the lower call option. While this limits potential profits, it also drastically decreases the upfront costs to the investment, and it limits risk at the same time. So when the buyer wants or thinks that the price of the stock will increase but not drastically, they want it to increase to a value between the lower call option and the higher call option strike prices. If they're correct, they can exercise the lower option, the lower call option, and sell that option to earn profit. If the buyer is incorrect, though, they just lose the premium they paid. Using these numbers as an example, $249 initial value with a strike price of $247 and $254 for the lower and upper respectively. They can simultaneously purchase the $25 per share call option at $247 strike price and $254 call option at $22. When you look at the difference between those, they're only paying $300 for the option, which is a considerable savings. The break-even point would be $250, and the maximum profit potential is only $400. So the risk is fairly low. They can lose $300, or they can gain only up to $400. And looking at this graphically, you can see both of these caps as the price of the stock either decreases below the lower strike or above the upper strike. So while the risk is lower, the profit also is lower as well. Bear spreads are essentially the inverse, where you're using puts instead of calls. So with a bear put option, the buyer sells a put option at a lower price while simultaneously purchasing a put option at a higher price with the same expiration date, and using that profit from selling the lower put option to purchase the higher put option. They'll use this when they expect the price of the stock to decrease moderately in the future, not drastically, but somewhere between the lower put option strike price and the higher put option strike price. If the buyer is correct, they can exercise the higher option or sell that option to earn a profit. If the buyer is incorrect, they lose all of the premium they invested. So looking at an example with $249 per share stock value, and they want a bear put with $251 for the high strike price and $244 for the lower. If they simultaneously sell a $244 put option for $22 and purchase a $251 for put option for $25, that spread of $3 amounts to $300 total premium, and that's the maximum loss. And then if you look at the maximum profit potential here, you have $400 total again. And looking at this graph, it's a little bit different from the previous option in that all this profit is capped as the price of the asset drops. When you increase the price of the asset, you cap your losses at the $300 premium. So the straddle is one more opportunity for investors to utilize different types of option strategies in a combination and tailor their investment the way they like. In this strategy, the investor holds a position in both a call and a put with the same strike price and expiration date. The idea behind this is that they can capitalize on both an increase in value and a decrease in value of the asset. And the only loss to them occurs when it's between the low break-even point and a high break-even point, which we'll look at in a moment. So assuming a stock is trading at $35 per share, and assuming this is the strike price, we'll say the investor enters the straddle with $1.50 per share call and a $1 per share put. The maximum possible loss then for 100 shares is $250. And there are two break-even points, one at $35 plus $250 and one at that strike price minus $250 per share. And it's between these two break-even points that they're losing money. And we'll look at this graph. And you can see graphically here how as the price decreases, the profit is increasing. And this is all exercising the put option here, where the call option is being exercised as the price increases. And when the call option is exercised, the put option is worthless, and vice versa. In between these break-even prices, if the stock doesn't change in value, that's the only time the investor actually loses money, and they just lose the premium they invested. So we looked at a couple of the pros, the profit potential, whether it goes up or down, or in the fact that there's no limit to it. But the con behind this is if the stock does not change value, you lose money. So protective options are a little different. They're used almost as an insurance policy for a portfolio or an asset. And basically, when the investor owns the asset and suspects that the value is going to drop, they might purchase protective puts to put a lower limit on their losses. They buy it at a strike price, and they know that the value of their assets will not decrease below that strike price, because if they do, they can always exercise the option and sell the assets at that strike price. So that is their maximum loss. The good thing about this also, it's protecting their asset without them having to liquidate it or change it to cash, because when you do that, there's no potential for upside gains if the market takes a turn for the better. So in this case, if the portfolio rises, the puts may be worthless, but the investor still makes profits from the increasing portfolio value. And if the prices remain stable, then although the puts are worthless and you don't make the money from a market increase, you can consider that an insurance cost for the portfolio. So looking at some numbers, $250 per share, and if you own 100 shares of that stock, fear the market will decline. You could set a strike price at $245 and buy a put option for $550 per share, $550 total premium. If the market increases to say $260, your net profit is going to be $450. If it remains the same, then you're going to lose $550 premium. However, the price falls to $235 per share. If you didn't have the protective put, you might lose $1,500. But if you exercise that option with the protective put, you're going to limit your losses. Looking at this graphically, you can see this lower limit, and you can also see that the top is not capped. You can make limitless profits with this, although the profits are going to be slightly lower at any given share price than the portfolio would have without the protective put. But that's just the cost of guaranteeing that you won't lose more money than the lower limit. So another type of protective option is protective collar, and this is a combination of a protective put purchase at a strike price below the current stock price and a short call sale at a strike price above the current stock price, both having the same expiration. And just like with the spreads, the premium earned from the sale of the call option pays for some of the purchase of the protective put. So the upfront investment is lower than it would be just to put protective puts on the portfolio. But in exchange for this lower upfront investment, you're also capping your potential profits by selling that call at a certain price. So looking at numbers here, $250 per share for 100 shares. Say you purchase or you sell a call option with a strike price of $255 per share, and you receive a premium of $5 per share. You spend $500 on that and put that towards the purchase of put options with a strike price of $248 and a premium of $550 per share. Then you're only paying $50 for the upfront investment. So if the value drops, you can always sell, exercise that option, and you know you're going to get the lower strike price for your assets. If it rises, you'll still make a profit, but you'll only make a profit up to that upper strike price. Anything above that, you'll be losing to the call buyer because they will exercise their option. And so, with the investor's profits are capped, but the risks are also capped for a lower price than you would have just by installing protective puts. And you can see this graphically here, where you have an upper and a lower cap. So in conclusion, options give investors the ability to manipulate and to some extent control the risk of their portfolios in an unpredictable market when they aren't necessarily going to be at the mercy of a market declining. They can use options that can capitalize on a decline. Options also give investors the flexibility that futures don't, since futures carry with them an obligation to the buyer. And of course, there's a potential for combining strategies and giving investors the ability to both decrease or eliminate certain risks, and also just customize their portfolio and the types of risks they're taking with specific goals in mind.
Hi, my name is Jed, and I researched the history of long-term capital management. They're a hedge fund that began in 1994 and operated until 1998 when they had to be bailed out by their creditors, and which was orchestrated by the Federal Reserve. I'd like to tell you how LTCM was formed, about the fallout and the weaknesses of their strategy that led to that. First of all, in the 90s, it's important to understand some of the things that were different or that were unique to that era. The Black-Scholes equation was seeing widespread use. It was the formula that told you what the true value of different securities should be, and then you had the opportunity to see where the market rate was different and to profit off of that. This wouldn't have been possible without computers, because even though the model made things slightly simpler to calculate, there were still too many to calculate just by hand and to do have any valuable analysis of them. Another important factor is that there was an overabundance of capital. The economy was doing very well, so banks were eager to invest, and that meant that maybe they didn't do some of the due diligence that they should have on some of their investments. John Meriwether was a manager at Salomon Brothers, and he had a good resume in the bond market. He had a team of professors and academics working for him that understood the models and calculated these models for the group. Unfortunately, a subordinate of his did some unscrupulous reporting with the government, and because of the way he handled it, John Meriwether was forced to resign. He still enjoyed a good reputation among the financial industry, so when he decided to begin a fund, he had a lot of partners as far as the banks were concerned. He took most of his team from Salomon Brothers with him, and to that he added some world-renowned economists, including 2 Nobel Prize winners. One of them was Robert Merton and Myron Scholes. In addition to that, he added the former vice chairman of the Federal Reserve, whose picture I couldn't find. And in one of my sources I read that the group went to great lengths to remain anonymous, going so far as to purchase the rights to their pictures from newspapers, which I can't think of any other reason why the vice chairman of the Federal Reserve wouldn't have his picture anywhere on the on the internet. LTCM's strategy was, as I said, to look for these spreads where a security was overvalued compared to other ones in that of a similar type. And as I said, they particularly were good at bonds. So an example of what they would do is a 30-year Treasury note. When it was released, it has a great deal of liquidity. A lot of people are trading it. But 6 months later, when a new one is released, people stop trading it, and that lack of liquidity reduces its price slightly. But 6 months later, when the next one is released, that gap narrows considerably. So that was one of their favorite trades. The other part of their strategy, because returns were so narrow on arbitrage, it required them to borrow a great deal of money to enhance their profits, which at the same time increased their losses. But this was built into their strategy from the beginning. Their goal was to have the same amount of volatility as the S&P 500. So if a hedge was 30 times safer than buying a typical mutual fund or something like that, then they would borrow 30 times over to make that volatility the same. Then if the security became more volatile, their idea was to sell some of it off until their leverage became lower. and therefore their risk went down. Or if it became less volatile, they would leverage it even more. They also were very concerned about letting their strategies out to their competitors, which included their lenders. So they were very careful not to reveal what their investments were as much as was possible. This is an example of arbitrage. Their models would look for places where there was a spread between two securities, and of course they would go long on the one that was undervalued and short on the one that was overvalued, and then when the gap narrowed they would make a profit. And it didn't matter if the market for this security went up and down in total, because the two securities would cancel each other out in that respect. Because of their reputation and their early success, they had access to an extreme amount of capital for a hedge fund. It was, like I said, it was a bull market at the time, so banks were willing to invest, particularly in hedge funds, and people were excited about the Black-Scholes equation and the models that the computers were generating. So there was a lot of leeway given to this company, too much in fact. What sparked the downfall of LTCM is a problem with Russia. They downgraded their debt, so they basically said that they would postpone or not pay on bonds that they had issued. And LTCM was heavily invested in Russia, and that set off a chain effect where markets around the world panicked. Because of the size of long-term capital management, the government and their investors were concerned that if they went bankrupt and all their creditors took their assets and liquidated immediately, it would make gyrations in the global economy that would have really serious consequences. The partners in the company and many of the creditors that lent to them lost fortunes. The richest partner at one point had $500 million in the fund, and some of the really large banks that lent to them lost half of their stock price. These well-respected academics and business people faced humiliation, and it started a widespread skepticism of academia, which was slowly taking over from the traders that would trade based on their gut and rumors and that kind of thing. Some of the problems with this strategy: they didn't account for the volatility that occurs when there's extreme events in the market. Humans still tend to panic and have more extreme reaction when the price of a security is very high or very low. And they also didn't account for the fact that when different markets face these extreme circumstances, that they started to act as one. So they became less independent, which implies that the risk of their portfolio would increase. They didn't have liquidity, so when this happened, they were just so large that if they started to sell all of these options at once to lower their leverage and their losses and everything, it would actually have a seismic effect on the market. So they became so large that the moves that they made actually affected themselves negatively, and they also opened themselves to unbounded losses. Here's a picture of what kurtosis looks like graphically. As you can see in the middle there, the fat tails, an event that LTCM might have only thought would happen once in a million years may happen once in 10 or 20 years. In fact, one source says that if they had just extended their models out an additional 10 years, they would have caught some activity on the market that would have shown higher risk in their portfolio that wasn't reflected otherwise. So their thinking was too short term. At their peak, long term had $6 billion in capital, but with leverage that translated to over $200 billion in assets. And that size, even the $6 billion was larger than a lot of the very large banks that were lending to them. And it's been shown that when a hedge fund becomes really large, their profits will go down. That translates to about 30-to-1 leverage, which is about the ratio that they aimed for from the beginning. It's important to remember that if you are an investor, it's your responsibility to understand what you're investing into. There are some things that the government puts in place and so on to try to protect investors from unreasonable, from different scandalous activities. But at the end of the day, it's your responsibility to understand an instrument. Even if you give it to someone else for them to invest, it's not enough usually to trust it to them. You have to know what they're doing. When new models come around, it's important to test them out and don't go throwing money at them the way LTCM did until they've had at least decades of success. There's nothing new under the sun. The stock market crash is not a new thing, and it's very common for people to borrow money and invest it, and when it comes time for them to repay on losses, that money's not there. And these types of things seem to continue to repeat themselves.